Good evening, friends. Today we are going to discuss about few provision of transfer pricing and few amendments brought into the statute books by Finance Act 2020. Now let's start with thing capitalization. It's a topic from transfer pricing. What is the meaning of thing capitalization? Presume a situation. Presume a situation. Suppose X Limited. Sorry. Suppose X Limited is incorporated in India. Now, this company require funds. We all know there are two ways of obtaining funds. Number one is by way of share capital, and another way is by way of debt. If a person invests in this company as a share capital, he will get dividend, and this person will get interest. We further know that dividend payment of dividend or distribution of dividend is not deductible item in hands of X Limited. It is not deductible, whereas the interest expenditure is deductible as business expenditure in hands of X Limited. We all know all these things. I am repeating myself. X Limited is incorporated into India. Now that company requires fund. There are two ways to obtain the fund requirement. To avail the fund requirement, number one is by way of share capital, by way of issuance of shares, and another way is by way of debt, obtaining loan. If the company procure fund by way of share capital, in return, the company is required to distribute dividend to its shareholders, and that dividend is not deductible item in hands of X Limited while computing his total income. Whereas in case of debt, the company is required to pay interest, and this interest is eligible as expenditure, as deductible expenditure in hands of X Limited. From the tax point of view, interest obtaining fund, procuring fund by way of debt is obviously beneficial to the X Limited. Now think a situation. Suppose MNC procure fund from its multinational partner, say Y Inc., Lot US. Now what happened? The Y Inc. and X Limited are an associated enterprises. We presume that these are the associated enterprises, and Y Inc. invested money in X Limited by way of share capital. If suppose Y Inc. invest money in X Limited by way of share capital, in lieu of that, while X Limited will distribute dividend to Y Inc., this dividend is not deductible expenditure in hands of X Limited. It's okay. But what happened if the fund is invested by way of debt? Then this interest expenditure is deductible in the hands of X Limited. Say higher rate of interest is charged by Y Inc. because they are associated enterprise. By way of this, they are the fund of Indian fund has been transferred to Y Inc., that is a foreign country, without paying any tax. X Limited got tax benefit. If Y Inc. is liable to pay tax, then it is the tax liability overall tax amount is zero. X Limited deductible expenditure, Y Inc. it is taxable, almost it is zero revenue for the government. But what happened? The amount of Indian currency, Indian money, Indian income shall be transferred to US without getting any tax revenue to the Indian government. To prevent this type of situation, government has introduced this new provision uh, 3 years back, that is called thin capitalization. What is it under section 94B? What is the thin capitalization? We got that thing. What has happened to prevent this type of tax planning, to prevent this type of base erosion from India? Government has introduced the provision of thin capitalization as section 94B in the statute books. When it is applicable? It is applicable only when an Indian company or a permanent establishment of a foreign company in India is a borrower. Indian company or a permanent establishment of a foreign company in India is the borrower. What are the conditions? If these conditions are fulfilled, then this provision is applicable. What is the provision? Provision is to restrict expenditure on account of interest. What are the conditions? The borrower has debt issued by a non-resident being an associated enterprise of such borrower. That means the borrower has a debt. That means in our example, X Limited obtained money from a non-resident. That non-resident person is an associated enterprise of X Limited. He incurs any expenditure by way of interest or of similar nature exceeding rupees 1 crore. X Limited is required to pay interest amounting to rupees 1 crore or more than 1 crore rupees. And such interest expenditure is eligible as deduction while computing its profit from businessing. If these three conditions are fulfilled, what are the conditions? Number one, the borrower has debt. The debt should be issued by a non-resident associated person. Number three, the borrower is supposed to pay interest in excess of rupees 1 crore. Number three, such interest is eligible as deductions while computing its business income. If all these three conditions are fulfilled, then excess interest means being lower of the following shall be disallowed while computing income of borrower. What is the excess interest? Excess interest means the lower of these two. What are these two? An amount of total interest paid or payable in excess of 30% of EBITDA of the borrower. What is EBITDA? Earning before interest, tax, depreciation, or any amortization. The income, that is EBITA into 30%. That is the upper cap provided by the statute books on this type of interest. Interest expenditure, there is upper cap, there is upper limit set by the statute under section 94B. An amount of total interest paid or payable in excess of 30% of earning before interest, tax, depreciation, and amortization of the borrower, or interest paid or payable to associated enterprise. If you are paying interest to Y Inc. in our example, that amount or 30% of EBITDA, whichever is lower, shall be considered as a excess interest. That excess interest shall be disallowed while computing total income of borrower, Indian borrower. However, such excess interest is available for set off in future assessment year up to 8 years, just like set off provision. However, while set off while set off the excess amount, excess interest expenditure in future year, this limit shall also be examined, shall also be checked. If within this limit, the excess interest is eligible for set off in future years, that is up to maximum up to 8 assessment years. However, this provision is not applicable in these two type of situations. If the borrower is in the business of banking or insurance, and one more exemption, one more exception has been inserted by Finance Act 2020. Now, one example is there. Suppose EBIDT of the Indian borrower, case number 1, is 100. What will be the first limit of calculating maximum interest, eligible interest? That is 30% of EBITDA. If your EBITDA is 100, then 30% of the above is 30. That is the number A. Say, interest payable to associated enterprise, it is given as 35. Interest payable to non-associated enterprise is given as C. Total interest expenditure of the borrower is 35. Total interest expenditure in hands of borrower is 35. Now, what is the excess interest? 30% of EBITDA or interest payable to associated enterprise. In our case, 30 or 35, whichever, excess, in excess of 30%. Total interest is payable is 35. 35 minus 30 is 5. First limit is 5. And second one is total interest payable to associated enterprise, that is 35. Whichever is lower, 5. Excess interest is 5, and that interest shall be disallowed under section 94B while computing total income of Indian borrower. Case number 2. In case number 2, EBITDA of Indian borrower is 100, hence 30% of this is 30. Interest payable to associated enterprise is nil. Interest payable to non-associated enterprise is 35. Altogether, the company is paying interest amounting to rupees 35. Interest in excess of 30% of EBITDA is 5, and interest payable to associated enterprise, that is nil. 5 or nil, whichever is lower shall be considered as a lower shall be considered as a excess interest. In our example, in this instant, nothing shall be disallowed under section 94B. Case number 3. EBITDA of the Indian borrower is 100. 30% again is 30. Interest payable to associated enterprise is 15. Interest payable to non-associated enterprise is 20. Altogether, company is paying interest of rupees 35. Excess interest, first lien, excess payment in exceeding 30% of EBITDA is rupees 5, and interest payable to associated enterprise 15. Whichever is lower of these two part, 5 or 15, that is 5. 5 shall be disallowed while computing. 5 shall be disallowed while computing total income of Indian borrower. Any queries till now from think capitalization? Any query? I think I am audible. Am I audible? Please reply in chat. Am I audible? Now, our second topic for the session is secondary adjustment. What is a secondary adjustment? For example, suppose due to the provision of transfer pricing, suppose 100 crore was added in the total income of say X Limited. Say while computing total income X Limited on account of transfer pricing, addition of rupees 100 crore has been made by the assessing officer, and accordingly tax liability tax has been paid by X Limited. Now government thought we add income in while computing income of X Limited, but what happened if that money is not repatriated into India? Suppose if that money is repatriated into India, is come to India, then X Limited will also earn income of these 100 crore on in the future years. For example, in the first year, addition of rupees 100 crore has been made in the while computing transfer price, while computing total income of X Limited on account of transfer pricing, and a suitable tax has been paid by X Limited. If we consider this is the income of X Limited, then he may earn income on such income in future years, income on this 100 crore in future years. If that money is brought into India by X Limited from its associated enterprises, then certainly that company will earn income on that 100 crore in coming years, and accordingly government will get tax on that income on income. Say out of 100 crore, if that 100 crore is invested into India in say FD at the rate of 10%, say that is the not the rate, say income on that 100 crore in future years, if invested into India is 10 crore, hypothetically interest income earned by that company on that 100 crore is rupees say 10 crore, then government will definitely got some tax on that additional interest income. This will the story if only if that money is brought into India by X Limited. If that is not the case, then government will lose the tax in the future years on income on income, because there is no question of earning of 10 crore rupees in future years, because that money was not invested in by X Limited in any investment tools. So government thought that okay, it's fine, we are getting tax on 100 crore, but we are losing tax on income. So they brought section 92 CE in the statute books to tax that hypothetical income which is supposed to be earned in future years out of the addition made in the first year due to on account of transfer pricing provision. This is the hypothetical taxation of notional income of future year in future year is called secondary adjustment. So got it? Secondary adjustment means an adjustment in the books of accounts of the SSE and its associated enterprise to reflect that actual allocation of profit between the SSE and its associated enterprise are consistent with the transfer price determined as a result of primary adjustment. First addition of rupees 100 crore is known as primary adjustment. Thereby removing the imbalance between cash account and actual profit of the SSE. That is the very technical language, but in short, secondary adjustment means tax on the income addition on account of non if the assessee fails to brought income of primary adjustment in India, then notional interest income shall be considered in hands of the assessee by way of provision of section 92 CE. But it where a primary adjustment to transfer price has been made shoe moto by the assessee, the primary adjustment may be made by the assessee himself, made by the assessing officer, and that adjustment has been accepted by the assessee, is determined by the advance pricing agreement entered into by the assessee under section 92 CC, or is made as per safe harbor rules, or by way of any secondary adjustment. If these additions has been made in the if these secondary adjustment has been made while computing the income of the assessee, this is called the primary adjustment. If that adjustment, if that income is brought into India by that assessee, no issue. He may invest that money into say FD, he will earn income and accordingly tax will be payable. What happened if that money is not brought into India by the assessee, then notional interest shall be considered in the future year on that income. However, this provision is not applicable if the amount of primary adjustment in any previous year does not exceed rupees 1 crore. If the primary adjustment is up to rupees 1 crore, then nothing to be done in this provision under section 92 C. Secondary adjustment is not applicable for this type of primary adjustment. Or the primary adjustment is made on or before for assessment year on or before 1/4/2016. If these provisions, the provision of secondary adjustment is not applicable in these two type of situations. One more thing, one optional scheme is provided by our government, because say 100 crore addition has been made. Say 100 crore addition has been made. 100 crore addition has been made as a primary adjustment on account of transfer pricing. In next year, say we are a hypothetical interest shall be added in the total income of the assessee if due to this second provision of secondary adjustment, provided money has been not brought into India. Say hypothetical interest is say 10%, then 10 crore rupees shall be added in the books of X in the total income of X Limited. On this 10 crore, the company is required to pay tax to the government, and again in next year 10 crore, and again in next year 10 crore, and so on. It will be continuously taxable in hands of X Limited. Government thought, I will provide one scheme, pay one shot to the government on this 10 crore and relax. The scheme is optional. The optional is that first you are required to pay on a year-to-year basis, and number two is pay tax at the rate of 18%. Where excess money has not been repatriated within the prescribed time, the assessee may, at his option, pay additional income tax at the rate of 18% plus cess on such excess money. On which amount? 100 crore. On 100 crore, you pay 18 crore as a tax liability tax plus cess. 100 on 100 crore, you pay tax at the rate of 18% plus surcharge at the rate of 12% plus cess to the government of India. We will not liable you to pay tax on year-to-year basis on account of provision of section 92 CE. And you will not get any credit for the payment of this additional amount of tax. You will not get any deduction on account of payment of this type of tax. If this is suitable to you, this scheme is always available for you. If you are not opting for this scheme, pay tax on year-to-year basis on income, national income on that 100 crore. That is, say in our example is 10 crore. you pay tax in year 1 on 10 crore. In year 2, pay tax on 10 crore. In year 2, similarly in year 3, year 4, year 5, year 6, and so on. Or pay one shot tax at the rate of 18% on gross amount, that is 100 crore rupees. I think it is clear to you. Now, few more amendments brought into the statute books by Finance Act 2020. First of all, the major amendments which will change so many practical problems, that is abolition of DDT, dividend distribution tax. The provision of section 115O has been omitted by the statute books. That dividend distribution tax is no more applicable from this financial year. That is, companies and mutual fund under section 1023D were liable to pay DDT on payment of dividend. You all are aware about the provision of corporate dividend distribution tax or DDT on account of mutual fund. And such dividend was exempt in hands of the recipient. The company is liable to pay dividend distribution tax at the time of distribution of dividend, and similarly, and on the other sides of the coin, recipient of the dividend was not liable to pay tax on such dividend income. The dividend was exempted in hands of the recipient under section 1034. Now, the provision of DDT is removed. Now, sorry, the company is not liable to pay dividend distribution tax at the time of distribution of dividend. Other side, the shareholder is liable to pay tax on dividend income. Now onwards, the shareholder is liable to pay tax on dividend income. Earlier, what was the provision? Earlier, the company is supposed to pay dividend distribution tax at the time of distribution of dividend, and shareholder were exempt from paying any tax on dividend income. Now the situation has been reversed. The company is not liable to pay any dividend distribution tax at the time of the distribution of dividend, whereas the shareholder, the recipient, is liable to pay tax on dividend income. Furthermore, if you are earning dividend income, you may claim certain expenditure, but there is a restriction on claiming expenditure against your dividend income. You cannot claim any expenditure while computing your dividend income other than interest income, and that is up to 20% of the dividend income. Suppose you are earning dividend of rupees, say 1 lakh rupees, and you are saying that I have incurred certain expenditure for collecting that dividend. Since your dividend will be taxable under the head income from other sources, you may claim that the expenditure has been wholly and exclusively incurred for collecting that dividend. So I am eligible for deduction of rupees, say collection charges of rupees, say 2,000 rupees. Government said no, you are not eligible for claiming any deductions but interest from your dividend income. And moreover, interest up to 20% of your income. Say you are invested money in the company by obtaining borrowing fund, and on that borrowed money you are liable to pay interest, say 20,000. In the year you received a dividend of rupees, say 50,000. Then you will supposed to deduct your interest expenditure from that income, but the government has restricted your expenditure on account of interest shall be limited to 20% of your dividend income. 50,000 into 20%, that is 10,000. You will not get deduction of rupees 20,000 as interest was paid of rupees 20,000. You will not get deduction. That will be restricted up to 20% of your income. 50,000 minus 10,000, 40,000 shall be considered as your dividend income. No other expenditure shall be allowed while computing your dividend income. Surcharge on dividend is capped at the rate of 15%. All of you aware about that rate of surcharge. It is up to 37% in case of individual. On account of dividend, in case of dividend income, the surcharge has been capped up to 15%. No surcharge in excess of 15% shall be payable on dividend income. Similarly, one provision has also brought in Chapter 6A, that is deduction under Section 80M to safeguard the overlapping of interest, overlapping of dividend tax. Suppose your company earned 1 lakh as a dividend income and also distributed 50,000 or 70,000 as dividend. Your company earned rupees 1 lakh as dividend and also distribute 70,000 as dividend to its shareholder. Now, deduction under Section 80N is available to the company. 1 lakh is your dividend income. Deduction is available under Section 80M to the extent of dividend distributed by itself, that is rupees 70,000. Net 30,000 shall be considered as its dividend income. It is by way of deduction under Section 80M. Furthermore, domestic company is liable to deduct TDS on the dividend income at the rate of 10% if your dividend payable to one person exceeds rupees 5,000 during a particular year. Furthermore, the 10% rate of TDS has been reduced due to the coronavirus. Now, from 14th May 2020 to 31st March 2021, it is 7.5%. Thereafter, it will be 10%. One more change brought into the statute books in the very basic chapter, that is called residential status of an SSE. Residential status of an individual, Section 6. What is the case? Earlier, we all knows that in few circumstances, the second limb of Section 6(1) is not applicable. That is, the rule of 60 plus 365 days is not applicable. The provision was that if the SSE, if the Indian person, if the person is going abroad for employment purpose, then the provision of Section 6(1)(c) is not applicable. If the person is going as a crew member of an Indian ship, then the provision of Section 6(1)(c) is not applicable. These persons shall be considered as a resident person only if they stay in India during the previous year for 182 days or more. And one more link was there, one more exception was there. If you are a person of Indian origin or an Indian citizen and you comes to India for visit purpose, then also the provision of Section 6(1)(c) is not applicable. You will be considered as a resident in India only if your stay in India during that particular previous year is for 182 days or more. This third exception was somehow amended. The provision, the amended provision are as under. If you are a Indian citizen or a person of Indian origin, I'm not going to describe what is the person of Indian origin. He comes on a visit to India in any previous year, and his total income, other than income from foreign sources, during the previous year exceeds rupees 15 lakh. If these three conditions are fulfilled, then Section 6(1)(c) is applicable to him, but some modification, with modification. What is the modification? Instead of 60 plus 365 days rule, the new rule is 120 days plus 365 days. 120 up to 180 up to 181 days. plus 365 days in last 4 preceding previous year. If that person, if that individual resides, stay in India during the particular previous year for 123 days, and during the last 4 preceding previous year his stay in India is for 365 days, then that particular person shall be considered as a resident in India, which in earlier provisions before amendment, that person shall be termed as a non-resident in India, because the provision of section 6(1)(c) is not applicable. Only 182 days criteria is applicable. Now, if the person is resides, if the person stay in India for 120 days or more, but up to 181 days plus 365 days or more in 4 preceding previous year, then that person who comes to India for visit during the particular previous year, that person shall be termed as a resident in India. Got my point? And which type of residence? He will be considered as a resident, but not ordinary resident in India. Though he satisfied dual condition of section 6(6), he will be termed as a resident, but not ordinary resident in India. What happened if his total income during the previous year does not exceed rupees 15 lakh? All other conditions are fulfilled, but his total income during the previous year does not exceed rupees 15 lakh. Then he will be considered as a resident in India only if his stay during the previous year in India is for 182 days or more. Got my point? Next amendment. One more dimming provision has been inserted in residential status of an individual, that is called section 6(1)(a). If these conditions, if given conditions are fulfilled, then that person shall be deemed as a resident in India. That person shall be deemed as a resident in India. And which type of resident in India? Not ordinary resident in India. What are the conditions? He is a citizen of India. Be careful. The wording person of Indian origin is not over there. The citizen of India or person of Indian origin is there in this exception. However, person of Indian origin is not included in deeming provision of section 6(1)(a). The provision of section 6(1)(a) is only applicable if you are a citizen of India. Your total income other than income from foreign sources exceeds rupees 15 lakh during the previous year, and you are not liable to pay tax in any other country. You are a citizen of India. You are not satisfying any condition given under section 6(1). But due to this deeming provision, if these conditions are fulfilled, then you will be deemed as a resident in India. And which type of resident? Not ordinary resident in India. What are the conditions? You are citizen of India. Your total income, excluding income from foreign sources, does not exceeds rupees 15 lakh during that particular previous year, and you are not liable to pay tax in any other country by whatever the reason. Might be due to domicile, residence, or any other criteria, or whatever be the reason, you are not liable to pay tax in any other country. If these situations are fulfilled, and one more criteria I'm adding, that is, you are not satisfying any of the condition given under section 6(1). That is 182 days. If you are your stay in India is 182 days or more, you are not supposed to check provision of section 6(1)(a). If you are satisfying the section 6(1), then you are resident in India, or you may be ordinary or not ordinary resident as per the law. But you are not satisfying either of the conditions given under section 6(1), and you are satisfying these conditions, then you will be deemed as a resident in India. And which type of resident? You will be treated as a resident, but not ordinary resident in India. Got it? Now, few more amendments. Audit of accounts, tax audit, section 44AB. Earlier we knows that if turnover of a business exceeds rupees 1 crore, you are liable for tax audit. If your professional receipt exceeds rupees 50 lakh, you are liable for tax audit subject to section 44 AD or ADA or AE. One more provision has been inserted by the finance minister in last finance act, that is 2019. The provision was that, this was inserted by Finance Act 2020. The provision is like this: if your aggregate receipt during the previous year in cash does not exceed 5% of your aggregate receipt. That means suppose your turnover is say 2 crore, and out of 2 crore your cash sale is only of 8 lakh, and remaining is you are getting payment by way of banking channel. This is the first criteria. Second criteria is that if your aggregate payment does not exceed in cash does not exceed 5% of the aggregate payment. During the previous year, you paid rupees say 2 crore as a to your various vendor. However, in cash you made only 5 lakh, which is below 5% of your aggregate payment made to your vendor. If these 12 conditions are fulfilled, that means your business on banking channel or digital system, if these systems are, if this is the case, then the limit for tax audit is enhanced from 1 crore to rupees 5 crore. The threshold limit has been increased from rupees 1 crore to 5 crore. If this is the situation, that means that you are supposed to fulfill 12 conditions. First condition is that your aggregate receipt in cash does not exceed 5% of your aggregate receipt. Your payment in the cash during the previous year does not exceed 5% of your aggregate payment made by you to your vendors. If these 12 conditions are fulfilled, then the threshold limit for tax audit has been increased from 1 crore to rupees 5 crore. In the current Finance Bill 2021, the limit is proposed to be increased up to rupees 10 crore. Got my point? Furthermore, earlier what has happened, you are supposed to upload your tax audit report to the into the portal within the due date of furnishing return of income. Now, the furnishing of the tax audit report has been delinked from your due date of filing return of income. The provision says that earlier the due date of income tax return filing was the due date for filing your tax audit report. Now, these both due date has been delinked. The provision is like this. Now, new provision is like this. You are supposed to upload your tax audit report into the portal within 1 month prior to the due date of filing return of income. Suppose your due date of filing of return is 31st October. You are supposed to upload your return tax audit report to the portal by 30th September. Got it? Earlier, both of the date are same. Now, 1 month gap has been provided. If your due date of filing return of income is 31st October, then you are supposed to upload your tax audit report by 30th September, 1 month prior to your due date of filing return of income. One more amendment. Due date of furnishing return of income. Accordingly, the statute has changed the due date of filing return of income under section 139(1). New due date is instead of 30th September, the due date of filing return of income in case of individual non-audit case is 31st July. That date is the same. The earlier due date of filing tax audit return of income in case of audit is 30th September. Now it has been changed. It has been extended to 31st October. And by 30th September, you are supposed to file your tax audit report. And one more amendment has been brought into the statute. Earlier, in case of partnership firm, if you are a partner, if you are a working partner, and that partnership firm is liable for tax audit, then if you are a working partner, then your due date of filing return of income is same as per your the due date of filing return of income of your partnership firm. Now the word working has been removed, and accordingly the partner may be working or sleeping, whatever the type of the partner you are, you may file your return. Your due date of filing return of income is same as your due date of filing return of your partnership firm. If in case of audit case, a partnership firm is liable to file um, return of income by 31st October due to tax audit, then the partner, all partner, working or non-working, are the due date of filing return of income of all type of partner is 31st October. Any question? Now the session is open for question and answer. Any question? I think there is no question. Any question is there? Thanks.